It is often taught in financial education that you should hold your age in bonds as a percentage of your portfolio. This means if you are 25, 25% of your portfolio should be in bonds. But wait a second, why would you buy bonds when the government is issuing negative yields where the investor knows they're going to lose money, even after maturity? It's clear that this practice is outdated, to say the least, but why would anybody consider investing in something when they already know the return will be negative? Well, believe it or not, there is actually a reason. In this video, I'm going to explain why. But first, what are bonds exactly? When companies are just starting off and want to expand their business, they typically need extra funding. How do they go about raising these funds? Well, the first and most obvious answer is they borrow it from investors like me and you, using debt. Companies accumulate debt through the sale of bonds, which are essentially an agreement from you, the investor, and a company. The company sells you a bond and agrees to pay an interest rate on the borrowed amount over an agreed amount of time until the bond matures. Now, the main issue I would source with bonds is that you won't get crazy returns like you might with, say, stocks or real estate. A bond is more likely to earn you an interest rate of less than 3%, which would actually calculate to zero real returns when accounting for inflation. Now, bonds probably sound like a bit of a scam now, right? Well, it actually makes sense when you think about it. The interest rate paid on a loan typically refers to the borrowing party's ability to pay back the loan in full. If the debtor is in a lot of debt already and is more unlikely to pay back the loan, then investors will expect a higher interest rate to compensate for the added risk they pose. This is the classic risk-reward relationship you see in investing. Companies tend to pose less risk to the investor than individuals, and so often pay lower interest rates. Even safer than corporate bonds are government bonds. This is where the government borrows money off the investor. They typically pay very low interest rates because they are considered essentially risk-free. Theoretically, if a government cannot pay its debt back, it can simply tax its citizens more to make up for the difference. Now let's talk about where I think bonds can actually be useful. So remember back in February 2020 when the stock market was smooth sailing. If you bought bonds back then with a decent interest rate, they would have risen in aftermarket price considerably. When the stock market is mired in uncertainty, investors often flock to bonds for the security they provide. In my opinion, the 23rd of March 2020 would have been the perfect time to sell those bonds and funnel that money back into stocks which were at historic lows. Notable US YouTube investor Joseph Carlson did this exact thing and used his profits to snag some great deals on stocks, which will likely appreciate in value when investor sentiment improves. The problem with holding bonds for this reason, though, is that you never know when the market will crash or a big global event will affect bond prices, so it's a tough call. You may be wondering how much of my portfolio is invested in bonds, and well, 0%. I know that doesn't mean I've not been born yet. I just don't see the appeal. We are going through a hard time in the world right now, but when markets return to their normal selves with low volatility and high investor sentiment, bonds offer far less return on average than stocks. And yes, I know stocks are riskier, but they're not riskier in proportion to the returns you could be making. Now, this is not to say that you shouldn't hold some bonds. If you're like many people, seeing half of your net worth be obliterated in a stock market crash will possibly make you nervous and cause you to sell at historic lows and capitalise those losses. This is a situation in which some bonds may help keep your portfolio less volatile. After all, when stocks go lower, bonds go higher. So it's really down to what is best for your personal situation. Now, news recently broke that the UK was issuing their first negative yield bonds, which is ridiculous, right? Why would anybody buy them? Well, some people will. And to answer simply, there's just not really anywhere else to put your money. I mean, you have a bank account with historically low interest rates, real estate which is looking unstable, and then you have the stock market which is also unstable. It shows that some investors will take stability over risk, even if that risk is less than proportional to the gains they could make. I ran a poll to see other people's opinions on the amount of bonds you should have in your portfolio, and it seems most people agree with me that you should have none. But in this Facebook group, the majority of investors have good stomach for the stock market downturns, so don't take this as fact and invest to your personal beliefs. Thanks a lot for watching this short video on bonds. If you would like to support the channel, please consider clicking the like button and hitting subscribe. I thank all of you for your continued support on this channel and wish you the best on your investing journeys. Happy investing. If you would like to get a free share worth up to £100, please consider signing up to Trading 212 with the link in the description and deposit £1 into your account. This also helps support the channel in addition to giving you a sweet bonus. Thanks again for watching. See you next time.